Either 50 cents, 2 quarters, 5 dimes, or 10 nickels. That was the only obstacle keeping silver from $70 today. The market has been volatile, and the moves we're seeing aren't just random spikes. They're telling a story about supply, demand, and underlying risk. Silver touched $69.50, just shy of its nominal all-time high. And when you account for inflation, it's roughly $2.50 off the historic peak. That's not small change. It's a signal that industrial demand and investor flows are converging in a way that hasn't happened for decades. Gold hasn't been quiet either. It just hit a fresh all-time high of $4,444.40, a movement that's within a dime of its earlier record. Meanwhile, silver gained 1.75 to 68.97, marking a 2.6% spike today alone. Look closer. From its low of 67.09 to the high of 69.50, that's a microcosm of the volatility we're navigating. This isn't hype. Silver's up $138 to $1,122 this year, around a 7% jump compared to other metals. That's serious movement, and it's setting up scenarios that most traders aren't fully prepared for. Two factors are driving this action. First, expectations of further Federal Reserve rate cuts in 2026 have injected bullish pressure into the market. Silver reached $69 as we entered Christmas week, delivering the largest yearly gains in 46 years. Second, geopolitical tension is back in the mix. US actions around Venezuela, restrictions on oil shipments, and proxy conflicts in the Middle East are creating an undercurrent of uncertainty that benefits precious metals. This isn't fear-mongering. It's about flows, hedging, and scarcity interacting on a global stage. You might hear people point at COMEX positioning as the driver. Let's be clear. The latest CFTC data shows net bullish bets on COMEX silver futures are below their one-year average, yet prices have surged 21% since early October. The market isn't being manipulated by one exchange. It's being pushed by structural supply constraints, industrial demand, and speculative interest intersecting in real time. The scarcity is genuine. Approximately 60% of the world's silver supply is used industrially, and that demand is not shrinking. It's growing. Look at industrial consumption. It's up 3.5% this year alone, accounting for roughly 60% of silver's annual demand. The numbers tell us something important. Even as prices approach $70, industrial and investment demand isn't slowing. In fact, in places like Australia and Canada, prices have already crossed $100 and $95 respectively, showing that local markets are adjusting to a global squeeze. That's not speculation. That's data reflecting tangible pressure points in the supply chain. Now, consider what this means for volatility. Last month's short squeeze caused inflows to COMEX from London and Shanghai to spike, pushing futures trading in Shanghai to levels not seen since the crunch. The market is tight. When supply is restricted, even small changes in demand create outsized moves. Investors and industrial consumers alike are reacting to signals in real time, and what you're witnessing isn't just a seasonal blip. It's a structural shift. We are just scratching the surface. By the time the markets open in Tokyo, silver has already moved $69 again, and these aren't isolated blips. This is a global feedback loop in action, driven by policy expectations, geopolitical tension, and the reality of industrial demand. You need to pay attention because what happens next could set the tone for the first quarter of 2026. And if you think $70 is the ceiling, think again. This setup has more room to run or to shake out the weak hands. Let's dive deeper. What's driving these moves is more than just today's headline numbers. It's the interplay between monetary policy, geopolitics, and industrial demand. The first hidden angle is the Federal Reserve. Markets are pricing in rate cuts in 2026, which immediately puts silver in the spotlight as a hedge against a weaker dollar. Investors see an opportunity to preserve value, and industrial buyers are already locking in supply because prices aren't going down anytime soon. The anticipation itself fuels the momentum we're seeing. The second angle is geopolitics, which is no longer peripheral. It's central. Reports of US scrutiny on Venezuelan oil shipments, tensions in the Middle East, and potential conflicts around Iran create a risk premium that gold and silver are absorbing. These metals aren't just commodities, they're insurance policies. Every sanction, every potential blockade, every whisper of escalation nudges investors and industrial buyers to act preemptively. That's why silver surged past $69, and why we saw a fourth consecutive weekly gain this week. Institutional flows are reinforcing the move. Prominent banks like HSBC, Bank of America, and Goldman Sachs are now projecting gold at $5,000 per ounce. That's not fantasy. It's their internal models, and the market takes notice. When gold is under the microscope, silver follows. The correlation between the two is tightening because traders are looking at relative value. Silver is cheaper in nominal terms, but is reacting more aggressively to both macro risk and industrial demand. You see this pattern repeating in the Commitment of Traders report. Managed money speculators are still below their one-year average for net bullish positions, yet prices have surged 21% in a few months. This disconnect tells you one thing. The market is under-leveraged on the upside. Now, let's talk supply. The industrial demand tailwind is massive. Electronics, solar, medical equipment all require silver, and roughly 60% of supply is absorbed annually by industry. That scarcity isn't going away. Combined with speculative flows and tight futures markets in Shanghai and London, the setup is creating structural pressure. We're not just watching a short-term spike, we're observing a multi-layered squeeze that could define silver's trajectory for the next several quarters. Here's the kicker. Volatility is baked in. The silver squeeze in October proved that tight supply and sudden demand can generate outsized swings. Now, even small triggers, a geopolitical rumor, a rate comment, a minor inventory report, can move silver $1 or more in minutes. Traders are being forced to navigate a market that is increasingly reactive, and long-term holders must understand that these swings aren't anomalies. They're a feature of the current structure. Meanwhile, local markets are signaling similar pressure. In Australia, silver has already crossed $100 per ounce, and in Canada, it peaked at $95.11, showing that global dynamics are translating immediately into local prices. This isn't a US-centric story anymore. It's a worldwide trend. The message is clear. Tight supply, combined with industrial and investment demand, is creating conditions where silver can maintain elevated levels, even in the face of normal market pullbacks. Industrial demand, speculative inflows, and geopolitical tension are colliding, creating a market that's reactive, tight, and volatile. If you're thinking of sitting on the sidelines, waiting for a correction, understand this. There may not be a normal correction until supply catches up or demand slows, neither of which looks likely in 2026. Every day the market trades above $68. Every hour silver holds near $69. It's telling you something about structural imbalance. Next, we'll break down the technicals and chart levels that matter most, where bulls and bears collide, and what to watch if the market attempts a push beyond $70. The setup isn't just exciting, it's instructive. Understanding the mechanics now can give you an edge when volatility spikes again, which it inevitably will. The market isn't done signaling. Let's talk numbers and levels, because speculation without context is useless. Silver's range today is critical. $67.09 on the low, $69.50 on the high. Those aren't just numbers. They're thresholds that tell us where buyers and sellers are stepping in. Technically, $69.50 is a resistance level that has been tested multiple times this year, and breaking it convincingly signals a potential surge towards $72-$75. If it fails to hold, expect a pullback to $67 or even $65. Those are your immediate support zones, and knowing them is crucial for positioning. Momentum indicators are flashing bullish. On the daily chart, silver's RSI is approaching overbought territory, but that's expected in a strong uptrend. Overbought doesn't mean sell immediately. It means the metal is running hot, and short-term corrections could happen within a larger upward move. MACD shows continued upward momentum, signaling that the trend isn't exhausted. Combine that with volume spikes in COMEX and Shanghai futures, and the technical picture confirms what the fundamentals are already screaming. Tight supply, high demand, and investor attention are converging. Scenario analysis is essential here. Bullish case, silver breaks $69.50 and holds it through multiple sessions. That could trigger a rapid move to $72-$75 as short sellers cover positions and momentum traders pile in. The feedback loop we discussed in part 2 accelerates, industrial buyers scramble, and the market becomes increasingly reactive. Bearish case, silver fails at $69.50, pulls back to $67.65 and consolidates. That's not the end of the world. It's healthy consolidation. Those who bought lower levels can add on dips, and it gives the market a breather before the next leg up. Pay attention to global correlations. Gold, as we noted, is already at record highs, and historically, when gold breaks upward under similar macro conditions, silver tends to outperform on percentage gains. Platinum, palladium, and even rhodium are moving in tandem, signaling that industrial metals aren't being left behind. That reinforces the technical setups we're seeing in silver. It's not an isolated rally. It's part of a broader metals cycle influenced by monetary policy, geopolitics, and investor behavior. One overlooked factor is market psychology. Momentum traders watch thresholds like $69, $70, and $72 like hawks. Every breach triggers automated orders and human reaction alike. This is why we saw silver spike to $69 an hour after Tokyo markets opened. It's a direct reflection of liquidity being pulled into key zones. You can't ignore these moves. They create real pressure on shorts, and the resulting feedback loop can escalate price moves quickly. For traders, the actionable insight is simple. Know your levels, respect volatility, and anticipate both spikes and pullbacks. Don't over-leverage, but don't sit idly waiting for a perfect entry. This market doesn't provide them. For long-term holders, the story is different. Silver remains structurally constrained, and industrial demand continues to grow. Even if prices pull back temporarily, the trend over the next several quarters remains favorable. Finally, watch open interest in futures markets. Rising open interest alongside price increases confirms participation and validates the trend. When open interest starts declining while prices rise, that's a warning of potential exhaustion. Right now, open interest is holding steady, which signals that this trend is supported by both speculative and industrial flows. Now let's zoom out. What we're seeing in silver isn't just a short-term spike. It's part of a larger trend that's been building over years. Compare silver to gold. Gold has historically been a more stable store of value, but silver has outperformed during periods of industrial growth and macro uncertainty. This dual role, both as a store of value and a critical industrial metal, is creating unique dynamics. Investors need to understand that silver's behavior isn't isolated. It's connected to global markets, monetary policy, and industrial demand cycles. Long term, the structural deficit in silver supply is significant. Roughly 60% of global silver production goes to industry, and recycling alone won't fill the gap. As electrification, renewable energy, and manufacturing expand, demand isn't just sustained, it's accelerating. That's why we're seeing prices in local markets like Australia and Canada outpace US levels. The gap signals that scarcity is already priced in regionally, which is a strong indicator that silver's floor is moving higher. Looking at cycles, 2025 is shaping up to be the best year for silver since 1979. Historically, after major price spikes, silver tends to consolidate before entering another upward phase, often correlated with gold and broader monetary conditions. If the dollar weakens due to rate cuts, quantitative easing, or geopolitical stress, silver historically benefits more in percentage terms than gold. This isn't speculation. It's pattern recognition based on decades of market data. Institutional participation also drives the long-term narrative. Banks and large funds are factoring silver into portfolios as both a hedge and a growth asset. When macro risks, like geopolitical tensions or inflation expectations, align with structural supply shortages, these players don't just trade, they create sustained pressure. That's why even when COMEX positions show underleveraging, prices continue to climb. Long-term holders need to recognize that the metal isn't just moving with speculation, it's moving with fundamentals that aren't going away. Another angle is volatility. Short-term volatility may create anxiety, but long-term, it represents opportunity. Market cycles historically demonstrate that periods of rapid price spikes are followed by pullbacks, creating ideal entry points for strategic accumulation. Whether silver consolidates at $65 or dips to $60, these levels should be viewed not as failures, but as natural phases within an upward trajectory. Every correction strengthens the structural argument for higher prices over the medium to long term. Finally, consider the interplay between industrial demand and safe haven flows. Fear-driven buying from investors complements industrial-driven demand. When macro uncertainty rises, whether through geopolitical tensions, supply chain disruptions, or policy shifts, silver benefits from both fronts. This dual tailwind effect is rare and makes the current phase of silver accumulation historically significant. Investors and traders alike should monitor it carefully, understanding that volatility is not risk. It's information about where supply, demand, and sentiment are intersecting. Here's what it all comes down to. Silver isn't just reacting randomly. It's responding to structural forces, industrial demand, monetary policy, and geopolitical tensions. $69 isn't just a number. It's a checkpoint in a much larger trend. Those who understand the dynamics now have an edge because they see the convergence of factors that drive both volatility and opportunity. The combination of supply constraints, rising industrial consumption, and speculative flows is creating a market that can move aggressively, and you need to be aware of both the upside and the downside. Momentum is real, but it's fragile. A push above 69.50 could trigger another leg toward 72.75. A failure at this level could see silver pull back to 67.65, or even test lower support around 60.63s in extreme scenarios. These aren't guesses. They're logical levels derived from technical analysis and historical behavior. The key takeaway is simple. Know your entry points, respect your risk, and understand that the market will test your assumptions every step of the way. Industrial demand isn't slowing. Electrification, solar, medical applications, and manufacturing continue to absorb a significant portion of the world's silver supply. That structural deficit isn't going away, and it's amplified by investor interest. Gold and silver continue to move together, but silver's volatility creates opportunities for those who watch levels and patterns closely. Short-term traders can benefit from swings, and long-term holders are positioned to capture fundamental value. Geopolitical tension and macro uncertainty aren't just noise, they're fuel. Every report from Venezuela, Iran, or other hotspots impacts flows. Combined with expectations for US rate cuts and potential quantitative easing in 2026, silver is being pulled by both fear and function. The feedback loop is clear. Industrial demand tightens supply, investors respond to uncertainty, and prices adjust rapidly. You can't ignore either side of that equation if you want to make informed decisions. Volatility is the price of insight. Don't fear it. Use it. Whether it's $69 or $65, whether it surges to $72 or corrects to $60, each movement provides actionable information. The market is speaking through price, volume, and momentum. Your job is to listen carefully. Positioning isn't about predicting the exact number. It's about understanding the drivers, respecting risk, and knowing when the dynamics favor accumulation or caution. Silver is structurally bullish, technically active, and macro-driven. The next few months will test supply, demand, and sentiment, creating opportunities for both traders and long-term holders. The lesson here is that analysis trumps speculation. Track the levels, watch institutional flows, monitor industrial demand, and respect volatility. Remember, this is not financial advice. Do your own research, evaluate your own risk tolerance, and make informed decisions. The market is unpredictable, and the responsibility for every position rests with you. What we've done here is break down the drivers, the cycles, and the technical levels so you can see the bigger picture. Take these insights, apply them intelligently, and stay alert, because in 2026, silver isn't going to wait for anyone.